Hello, everyone, and welcome to this week's investment brief. I'm Tony Welch, Chief Investment Officer at Signature FD. I apologize. This week I'm suffering through a little bit of a cold and a sore throat, but we're going to go ahead and get through this webcast because we've had some interesting developments in the markets and the economy recently. So, in prior weeks, we've talked about how the markets environment has changed. Earlier this year, investors enjoyed a tailwind from expectations that the Federal Reserve would eventually cut interest rates. Well, today, that tailwind has become more of a crosswind as the Fed has shifted its attention back toward inflation. So, this week, I'd like to take that discussion here one step further. The encouraging news is that the economy continues to perform better than many expected. Businesses are investing, employment remains healthy, and corporate earnings continue to support this expansion here. Now, at the same time, we're also seeing signs that this bull market is becoming more mature. Now, that doesn't mean it's ending tomorrow. It simply means that the environment is becoming more challenging. Leadership is shifting, and valuations matter more than they did a year ago or so. And diversification is becoming increasingly valuable. So today we'll discuss three ideas. One, why does the economy continue to surprise on the upside? Two, why this is more similar to a mature bull market than an early bull market? And three, what this means for investors going forward. So let's start with last week's market performance. At first glance, it looked like a difficult week. The S&P 500 declined just under 2%. But once we look beneath the surface, a much more interesting story appears. Small cap stocks actually gained about 1% for the week. Value stocks finished slightly positive. Meanwhile, growth stocks fell more than 3.5%. And that tells us investors weren't simply selling everything. Instead, they continued to rotate away from some of the market's biggest winners into areas that have lagged over the past few years. Now, that rotation has actually been a recurring theme throughout much of the year and is one of the reasons we trimmed from mega cap US growth stocks and added to small caps and international stocks earlier this year. Now, one of the most encouraging developments we're seeing today is that economic growth is becoming more balanced. For much of the last 2 years, AI investment has done most of the heavy lifting. Companies were pouring money into chips, data centers, and software, while many other parts of the economy grew much more slowly. Now we're beginning to see that investment start to broaden out. Orders for machinery, industrial equipment, fabricated metals, and other capital goods has accelerated to the fastest pace in several years. And that's important because it suggests businesses are investing in much more than just artificial intelligence. Reshoring, manufacturing, and traditional business investment are beginning to participate as well. A broader investment cycle tends to create a more durable expansion than one that's driven by one single industry. So, in fact, one of the more interesting outlook pieces that we read last week argued that artificial intelligence may have actually prevented the recession many economists had expected just 2 years ago. So, investment in AI infrastructure has exploded. Technology spending now represents nearly 5% of gross domestic product or GDP. And that exceeds even the levels reached during the internet boom around 2000. So, beyond the direct investment, rising AI related stock prices have also boosted household wealth, and that supports consumer spending along the way as well. The takeaway isn't that AI is a fad, it's that AI has become one of the primary engines supporting today's economy. The question for investors isn't whether AI matters, it's whether expectations have become so optimistic that markets begin demanding more proof over time. So, this brings us to the second theme. This bull market is no longer young. We've now enjoyed a remarkably strong advance for several years. Historically, that's not unusual. Bull markets don't simply end because they've lasted a long time. In fact, several have lasted longer than this current bull. But mature bull markets do behave differently. Investors become more optimistic, valuations become richer, more companies come public, and markets become a little less forgiving when expectations aren't met. And that's exactly the environment we're entering today. We're still constructive. We're simply recognizing that the margin for error has narrowed compared with where it was just a year or two ago. So, whenever markets become more mature, one of the first questions we ask is whether fewer stocks are participating in the advance. The good news is that the answer today is largely no. Some shorter term measures of market breadth have softened. That's worth watching, but the longer term evidence here remains constructive. Nearly 70% of industry groups remain in long term uptrends, and most stocks continue trading above their 200-day moving averages. So, in other words, leadership may be rotating, but participation remains healthy. And that's very different from the type of deterioration that we typically see before major bear markets. So, another theme we've discussed throughout the year has been the broadening of market leadership, or at least the shifting of market leadership. Technology had been an extraordinary performer in the prior few years, but increasingly we're seeing strength from financials, industrials, healthcare, and smaller companies as well. And that's healthy. Markets are generally stronger when gains are spread across many industries instead of depending on just a few companies. And recently, we've seen a healthy rotation from growth to value stocks. For investors, it's also a reminder that trying to predict next month's winning sector is often less productive than maintaining thoughtful diversification across market segments. So I'll leave you with three thoughts. First, the economy continues to surprise to the upside. Business investment remains strong, employment remains healthy, and the expansion continues. Second, this bull market is maturing. That's not a prediction that it's ending. It simply means valuations are higher, expectations are elevated, and markets may become a little more selective. And finally, diversification is beginning to matter more. Last week's market was a great example. Even though the S&P 500 declined, value stocks, small cap stocks, and bonds all held up relatively well. Different parts of a diversified portfolio did exactly what they're designed to do. As always, our focus isn't on predicting every twist and turn in markets. It's on building portfolios that can participate when opportunities arise while remaining resilient when uncertainty inevitably returns. That's what we have for you this week. Thanks for joining us. And as always, I want to wish you a great week ahead.